But of course, the jobs report out this morning, too. And the jobs report showing that fewer positions were added in August than economists expected, 22,000 to be exact, and downward revisions, in fact, to prior months to the tune of about 21,000. I do want to bring in Mark Hamrick. He's a senior economic analyst and Washington bureau chief for Bankrate. Mark, it's good to have you on the show this morning, joining us from our nation's capital. What is your reaction to this jobs report?
I think it's very consistent, Kristen, with the no hire, no fire job market narrative that we've been seeing for several months now. You know, it was about a month ago at this time where we were effectively knocked out of our chairs by the downward revisions for the previous 2 months that subtracted 258,000 jobs. And that really made us have a realignment about what we understood was going on with the job market. And this report's very consistent with that. We got the as expected a modest increase in the unemployment rate, in part because of an increase in labor force participation, more people looking for work. But I think, we also see a number of noteworthy issues coming in here where we have June now showing a contraction for the first time in several years. We have the unemployment rate at the highest level in a couple of years. And so then you dive down into the details. You see very little sector participation in the sense of jobs being added, healthcare, social assistance, leisure and hospitality, and that's about it. The goods producing sector is basically flatlining here.
What does this mean for borrowing costs and thus Americans' pocketbooks and their investment portfolios?
Yeah, that's very much near and dear to our hearts here at Bankrate, and the prospects are improving. The borrowing costs will be going down, and that's been true recently. For example, with mortgage rates, there's been no celebration in the streets about the relative level of mortgage rates, but they are moving in a direction that are more favorable for future prospective and actual home buyers. And if we get the sort of rate cuts that seem to be being priced into the market this morning, let's even just go with a minimum 25 basis point reduction at the September FOMC meeting. That then feeds on through to the prime lending rate that banks charge their best customers. And then ultimately that gets moved into areas eventually like home equity lines of credit, into credit card rates and other loans that are relevant for consumers.
Yeah. So in terms of how jobs fits into the Fed's dual mandate, we've discussed the data. The other key component for years, Mark, at least since 2022, that seemed to outweigh jobs when it came to the Fed's decision making on rates was inflation. What is your outlook for inflation, and how does that factor into the equation?
Very interesting these days, and it's also complicated, as you know, Kristen, because it's inflation with an asterisk in the view of what I think is now a growing number of Federal Reserve officials. And the asterisk really is associated with this notion of a one-time price adjustment as opposed to the ongoing onslaught of rising prices that we've been experiencing over the past several years. So what do I mean by that? And that is that if we have some stability in tariffs policy, and that is by no means a sure thing given the way the administration approaches this issue, let's assume that tariffs largely remain in place as they are as we speak today. So the one-time price adjustment means that prices adjust to that in the very near term and in the intermediate term. And then as we get out, let's say 12 months from now, something like that, the worst of the inflation pressures, the new inflation pressures, and the price adjustments are behind us. And so you have people like the Federal Reserve Board Governor Christopher Waller really leading the parade on the it's only a one-time price adjustment argument. And it's felt very much like Federal Reserve Chairman Jerome Powell is aligning with that, maybe not quite embracing it, but saying, okay, maybe we can get past this current period with downside aspects of the tariffs and focus on the maximum employment part of the mandate.
Yeah.
Meaning if you have mouths to feed, which one is the hungriest? It is indeed what we're seeing in the employment picture that is of the greatest concern.
Yeah. So for Americans watching this, Mark, what is your advice to them? How should they be navigating this environment?
Stick to the long-term plan, Kristen. We're very much creatures of the moment in the way our modern lives work, and that includes the feeds that we see, the noise of the moment, But a bank rate, a lot of themes are just very universal and time tested, and that includes for those that are saving for retirement. Many Americans feel that they are not saving enough for retirement. So that means be methodical about your long term investment strategy, and that is something that generally is very productive over the long term. We need to prioritize our emergency savings as well. Many Americans do not have sufficient emergency savings. And then we're still in an environment where debt is costly. So credit card rates still averaging new offers for the best qualified individuals above 20%. Let's try to retire that credit card debt ASAP. I love using credit cards as a tool, but I don't want to be charged that high rate of interest. So we need to pay those balances off almost immediately.
Mark Hamrick, Senior Economic Analyst and Washington Bureau Chief for Bankrate. Mark, always a pleasure. Thanks for joining.
Thank you, Kristen.
All right, everyone, still to come.